Good afternoon, ladies and gents. Welcome to another video brought to you by Total Control Traders. Been a while since we made a video, and I figured, hey, if anything, we have to make a video this week. You know why? Look at this. 10-year over 2-year has now inversed. So I wanted to make sure, since we've been discussing it before, I wanted to make sure to get the video out what this actually means, whether if it's going to be immediate pullback, So let's get into it. First of all, let's discuss the SPX. Same as usual, we're not going to change our schedule, so let's get this started. SPX, remember how we talked about there's going to be a huge opportunity on our last video from back here? Huge opportunity. So when we look at this chart, it is essentially a double bottom at this key zone. So we had to redraw some key zones in case that you're noticing. This key zone had to be moved up because multiple bounces here. This was a couple of dropping under it. No follow through. Nice to the upside after that. So whenever there's a breakout or breakdown, no follow through, there's going to be a very nice move to the opposite side. So essentially the key zones right here. 1, 2, 3 bounces from before. And now we're double bottom, triple bottom actually. 1, 2, triple bottom over there. And huge opportunity. And for those of you that remember from the last video, I mentioned that my main focus is going to be on the triple leverage. Now, regrettably, I'm going to say I did not catch the whole move or even anywhere near the whole move. If we were to take a look at FNGU, just as a quick example, FNGU, it ran, come on, all right, FNGU ran 103%. SOXL ran 68%. That's the type of opportunities that you're looking at with triple leverage whenever the market is bottoming out. You don't even have to worry about what's going on with individual tickers because these are triple leverage ETFs. And that's why I hope some of you have caught a decent chunk of those returns. 103%. Oh man. Anyways, congrats to those of you that have caught this big bull move. Now, what's going on going forward? Let's take a look. First of all, SPX, with this move, what I'm thinking now is similar to the pandemic move. Now, even on the way down, I was thinking that it's going to be similar to the pandemic move. The pullback amount, pandemic was 30-some%. And this pullback is not as big. It's about 20-some, if I remember right. Wait, is it only 14? 1 second here. 14% only. Anyways, all right, so let's do a comparison on side-by-side chart view. When we look at SPX, this is the recent moves, okay? And then if I were to move this back so the chart is a little bit clearer, there we go. So when we look at this chart, A, B, C correction. This is an A, B, C correction. And now the first leg has bounced over that B spot. So essentially what we're looking at is right over here. Now when we move forward, then we look at the consolidation. It consolidated to the 0.23, I want to say 0.236. It's been a while since we used this one. 0.236, yeah. So we consolidated to the 0.236, not even touching that 0.382. So what I'm thinking from here is there could be a very mild consolidation if the history is to repeat itself, if the chart is going to be similar to the pandemic of what I'm thinking, then Friday could be the temporary bottom on that pullback. So congrats to Darren on taking profit on your SQQQ. Now, when we go into the nitty-gritties, we can see there's going to be a bounce. The candles are very similar. And then it comes back down a little bit more. Almost touch at 0.236 again before the next leg up. So for those of you that are in bear positions that have not exited, don't worry about it. The other thing I want to discuss is on the monthly chart. So let's clean the chart up here. So on the monthly chart, we mentioned that there's going to be a huge opportunity. We also talked about how there is going to be a monthly bear divergence that we're going to be looking for that actual correction to happen, which timeline wise now might actually line up with that 10-year over 2-year inverse. So what I'm looking at here, because of the bounce is so strong on March, okay, essentially the bounce was so strong. And what I really like is when we go back to the daily, on March 31st, last day of the month. They did not close this at all-time high. Last day of the month, they started dropping it. So then when we go back to the monthly chart, you look at the candles, it's extremely similar to the pandemics. Okay, 1, 2, 3, right? So essentially 2 months of drop. Now 2 months of drop. Lower wicks forming over here. Lower wicks forming over here. The balance, if we were to close at high of the month, that's going to be a little bit concerning. But essentially we didn't. There's a little bit of upper wick. Same with this one. So from here, what we're looking at is for this month, there's going to be a little bit of a downward action before an actual bounce up. So very similar to this chart. And next month, we can actually close at close at the high of the month for next month. Now, from here, then we'll look at a slower move, very similar to the pandemic, a slower move to new all-time high. This is what I'm thinking, okay? It's just a thesis. A slower move to the new all-time high is not going to be anything similar to this bounce from the bottom. That 100% FNGU bounce is not going to be there. There might be another 100% move over the next 3-4 months. Yeah, that's for sure. Like, I mean, the chart is still strong, right? There might be another 100% move, but what we'll be looking at is something a little bit more like alongside of this line. 0.236, if we to lose that, we'll be looking at 0.382. Essentially, the 0.5 lines up the support and resistance, so we might pull back there. And then slower move to new all-time high. Then that is going to be the real concern going forward, right? Monthly, now I might have to drag this out a little bit more into fallish. Let's see, 1, 2, 3, 4 months. Okay, 4 months might make sense. 1, 2, 3, 4 August. Yeah, so August could be what we're looking at. August, and then this will be a monthly bear divergence, because the RSI will likely come back, depending on how fast we move, come back up, make a new low on the RSI. Then that's going to be the real monthly bear divergence. So if that does come true, then that'll be the time to start playing bears. Now, of course, this is on a longer time horizon on the monthly charts. So on the daily, this is exactly what we're looking at. You know, we're looking at for a pullback and then a slow move to the upside. How come it came back to May again? August. Something like that. Of course, it's not going to be a one straight shot. When we look at this one, right? It's a nice, low, steady move all the way to new all-time high before an actual pullback. So this pullback was actually mild. You know, I remember this period. It was a frustrating period because it's choppy down, choppy up, choppy down. Again, essentially it formed the W pattern. That's potentially not what I'm expecting. We will be looking for a pullback regardless. The pullback may actually be stronger. Now, the reason for that we'll discuss in US 10-year over 2-year. So with this chart, there were two things that we're looking at for that early sign of warning sign. Essentially, one is this first trend line. Let's change. This is old trend line. I don't use that color anymore. So this first trend line was a warning sign. We straight lost it on that 10-year over 2-year. Then this trend line over here, this support line, was a must hold. And we can see once we lost it, it backtest, and then it has been nothing but dropping. Now this is 10-year over 2 years, so whenever it does drop, that means the 10-year yield is becoming, whether that 10-year yield is becoming lower or the 2-year yield is becoming higher. So what that means for the inverse right now is essentially if you were to buy a 2-year US 2-year bond, you're gonna get paid more than if you were to buy a US 10-year bond. And if we were to convert that into layman's language, what that means is investors are more leaning towards short-term safety versus long-term safety. So what they're thinking is that essentially it's going to be a consolidation, a correction, whatever it's going to be. It's coming in the shorter term versus over the next 10 years. And that's why they're willing to pay a little bit more premium for it. You know, you get paid a lot more on US 2-year right now. So what this is, usually on the inverse, it is within that next 12 to 18 months. It could be 6 to 18 months. It could be a shortened period, because this time there's always going to be, history is always going to repeat itself when it comes to stock market, but it's never going to be exactly the same. So we're looking at this time, when we do a comparison again from back here, the last time that this US 10-year over 2-year topped out and then started inverse, the topping out part, it took 917 trading days. Okay, and then it inversed quite a while after that. And this time, so we started talking about this ever since the chart reached double top up here. This time, it only took 284 days before topping out, and then there was a double top at just over that previous all-time high. And the reason why we expected that this is going to go to inverse again very shortly is because this, remember what we just talked about, breakout, fake out, no follow through, and then there's also a double top. This was a sign that this is going to come down very significantly. It came down a lot more than I personally expected, and faster as well. But regardless, it is now inversed. So within the next 6 to 12 months, this does not mean that the market is going to start pulling back right away. Okay, it does not mean that the market is going to pull back right now from the inverse of a Friday. Okay, it means over the next 6 to 12 months, it may start becoming, if you start seeing that significant behavior change, if you start seeing that monthly bear divergence, if you start seeing any signs of big bears coming in, maybe even a catalyst, maybe even a huge bear headline, whatever it's gonna be, the chart is telling us that it's going to happen. Same with pandemic times. Pandemic, essentially the COVID was announced, I think somewhere in September, if I remember right. Between July and September, that it was happening in China. And then the whole pandemic actually started in February. But if we look at the charts, the inverse actually happened in August of 2019. And then from there, February, boom, right? The market starts tanking. This starts going back up. People start buying 10-year again. So this is basically a shortened timeline, and that's why I'm saying, even though normally it's 12 to 18 months, this time it may take 6 months, maybe even shorter, 3 months, might even consider 2 months. Okay, this is unprecedented. It is different. It is shortened than all of the previous times. There's a chart that goes beyond past this, but oh wait, TradingView actually has it now. They didn't chart anything up until here, but it looks like they started charting it again. Huh. So if you were to go back to history, maybe you can even look at when this was February 2000, the inverse before the pandemic one. When was the 2000 crash? Year 2000 crash. I don't know the exact month off the top of my head. April. So that's actually 2 months. This correction, is this right? No, so the first inverse actually happened right around here. So 2 years before. The first inverse happened in May of 1998. Right? So basically 2 years before the actual pullback. It bounced up and then it came back down inverse again. So that was 2 years. And then with the pandemic one, it was August, about 6 months. 6 months before it actually happened, meaning that this one, because it's shortened again, we could very well be looking at 2 to 3 months kind of a thing. Timeline wise, 2, 3, 4 months timeline wise would line up with that monthly bear divergence. So that's my thought for the overall market over the next, let's call it 2022. Right? For the bulls out there, you might be thinking, okay, this is bullshit, whatever. But hey, that's what the chart's telling me. I don't look at news. Unless there's, of course, a catalyst, something huge happening, like the pandemic. Even if you don't look at news, you're gonna know what's happening. Same with the year 2000. Even if you don't look at news, I wasn't even in the finance industry back then. I knew that the market was crashing, right? It's going to be something like that. Just the timeline wise, I'm personally leaning towards anywhere between 3 to 6 months. To be more accurate, it would be 3 to 12 months. I don't think it's going to drag out to 18 months, but anywhere between 3 to 12. I can't say for sure, but 90% kind of thing. Yeah. And then between 2 to 6 months is what I'll be leaning towards for, due to the way that the chart behaved on the US 10-year over 2-year, how short it ran up this time, how short of a time it took to run up this time, how short of a time it took to run down this time. Okay, so wanted to make sure that we discuss that US 10-year over 2-year because it has been on top of mind and the chat room has been talking about it. You know, people have been messaging me, hey, it's actually inversed. There's been a couple wicks from before. I think it's just TradingView glitches, but this is, I believe this is an actual inverse now. Does not look like a glitch to me. Does not look like a charting problem. Yeah. So that's where my head's at. Now let's get into the other leading indicators to see, you know, whether if this thesis is going to be backed up. So SPX, a few months out, right? So monthly bear divergence lines up with the timeline. US 10-year over 2-year, a few months, you know, that lines up with the timeline as well. 3 to 6 months, kind of what I'm leaning towards, personal opinion. US dollars, okay. This is one thing that's very interesting as well that I've been looking at. US dollars. Now look at the bounce on the market. Remember, FNGU, which is the FANG stock, the top 5-6 US stocks plus more, plus a couple of China stocks. That ETF, triple leverage, even though it's triple leveraged, it bounced 103%. So if you divide it by 3, that's still 30-some%, right? 30-some% bounce from the biggest stocks, the leading indicators, the industry leaders, bounced 30-some%. And then US dollar is now coming down. So that's another, I think, plus for the bear side on the long run, that, you know, something you want to be paying attention to. We broke bull. Okay, this trend line, this long-term trend line. Let's take a look at the weekly chart here. Long-term trend line, bounce, 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 bounce. Another triple bounces here. Another bounce over here. And then we lost it, back tested, right? And then on the way up, we got another 2 rejections. So this red trend line is very significant. Sorry, forgot to mute my computer. The 1, 2, 3, 4, 5, 6, 7 back test. 8, 9 reactions to this trend line already. Now we zoom into the daily. Look what happened. We broke bull on this trend line. Now we're not giving up on it. The bulls are not giving up on this rising trend line. Right? It's not going to be too accurate because of how long that trend line has been. It's going to be somewhere around here. But regardless, look at that wick. Look at these 2 wicks. US dollars is another plus for that bear thesis. It's not giving up even when the market is bouncing. All right, VIX has not made new all-time low. Oh, VIX looks like it's getting coiled. Oh, I shouldn't say that. That's a term for a different thesis. We did not back test this previous trend line. 1, 2, 3 bounces. Straight loss, no immediate back test. Straight loss, yeah, no immediate back test. So it looks like, you know, daily is that 4 hours? 4 hour oversold. If we were to make a new low on VIX, there's gonna be a bull divergence, and I can see this bouncing to back test that trend line. So short term wise, you know, there's gonna be, VIX is showing that there's potential for a little bit of bearish action coming in on the short term wise. As of right now, it is still a daily bear flag. And then the next one is gold. Okay, gold double top. So what we could be looking at from here, because essentially it came down and there's no follow through so far, and there's lower wicks forming. What I could be looking at is very similar to that US 10-year over 2-year chart. Let's do this. You know, you're going to be forming a U kind of a shape, and it might not make a new high regardless. It's going to be, double top, triple top due to the top from back here. So this could be another thing before coming back down. But the good thing, or the bad thing for the bulls, is gold is not actually seeing follow through on this double top. Means we could be seeing another leg up, which lines up with the market bear thesis. Whenever the market is bearish, there is gonna be bullish action for the gold. Okay, Bitcoin wise, so monthly bear divergence still playing out. Let's clean the chart up a little bit. So it is still actually, I don't know if I would call this a monthly bear flag. No, not anymore. So this is a monthly bear divergence. First leg down, slow bounce, nice lower wicks, increasing bull volume. So it's kind of interesting. I don't see this going to the upside, but right now the bulls are holding up strong. Based on the chart, what I can't see is coming up here before coming back down to the GP. Might actually be even sooner. Based on the monthly bear divergence, a strong monthly bear divergence, my anticipation would actually be this month or next month is going to start dropping again on Bitcoin. All right, so that's it for the market. We're going to stick to the market this time and not really discuss any individual tickers. Actually, give me 1 second here. Yeah, we're going to stick to the market. Overall, I think to me it's the most important right now, regardless of what you're going to be playing, because of the way the market's acting. On this drop, everything dropped. Remember how in the last time that we talked about, the most important trend line was this trend line, right? This green trend line over here. This was the most important trend line. On the loss of that, we saw a huge follow through to the downside, right? And then from back here, we talked about how there's going to be a huge opportunity. Big bounce to the upside. Now that the 10-year over 2 years inversed, we will still be looking at new market new all-time high. That would make the most sense from a chart perspective on the market. That would make the most sense from the chart perspective on US dollars, gold, everything. On the timeline wise, on the charting wise, I think it makes the most sense. One thing to note on the daily time frame, there is slight increase in bear volume, but you can see that is lower than the bullish volume on the way up. So that does also show that the potential thesis of slow grind up being the next leg from similar to here. Let's actually just circle that so we remember what we talked about in this video. So this is what we'll be looking for, and that very similar action. So thank you for tuning in. Thank you for watching. If you know anyone that may benefit from the videos that we share, please consider sharing our channel with them. Share the love. Don't forget to give a thumbs up, and I will see you in the next video.